Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Michael Cross. Michael is the Global Head of Sovereign and Public Funds at HSBC Global Asset Management. This conversation is an incredible one as we talk to a former central banker around the history of the Asian crisis, the Russian crisis, the sovereign debt crisis, the GFC and COVID, and how they're all different or similar in some cases. We seek to demystify the thinking behind central banks. We talk to Michael about his role as a market outreach person at the Bank of England. We talk about the differential between the real economy and financial markets. We get his perspective on the inflation-deflation debate. We also then talk about a number of the risks in the marketplace and how investors can avoid blind spots. And we even talk about a couple of canary in the coal mine situations that investors need to be wary of in the next couple of years. I hope you enjoy the conversation. So, Michael, one of the things I really wanted to get your perspective on is your background, and your background has an amazing array of experiences over the last 25 years, from the Asian crisis, the GFC, COVID, and probably the Latin American crisis. Can you give us a bit of background in terms of your experience across those last 25 years?
Yeah, I spent I've been in three organisations, and as you say, I've been lucky enough to be in some fairly interesting situations, including probably more through luck than judgment, and maybe it was the bad luck of my employers that I was sort of at the sharp end of the operational response to quite a few crises. So I kind of started at the Bank of England in the early 90s, and one of the things I was responsible for was supervising some of our money market intermediaries, and they had a really tough time during the ERM crisis when sterling fell out of the European exchange rate mechanism. Interest rates in the UK spiked up to 12 and at one point 15%, and that was sort of my first experience of a financial crisis, which then led to a recession in the UK. I joined the IMF in the late 1990s, actually, to be precise, in July of 1997. And I was fortunate enough to be the private secretary of the managing director of the IMF, so the head of the IMF, a great man called Michel Kamdasou. And within 2 weeks of me joining, Thailand needed a big IMF program, and that was the beginning of the Asian crisis. So I saw that period through, the big crises in Thailand, Indonesia, Korea, the strains across the whole region, and then the Russian default in '98. So that was first-hand experience of a genuinely global crisis that had a financial element. In 2007, I was put in charge of the Bank of England's domestic currency balance sheet, and within 6 months, a big UK mortgage bank called Northern Rock failed. And for us, that was the beginning of the global financial crisis. So in the UK, that crisis began about a year before most people kind of would associate the beginning of the crisis, which was September of 2008 with Lehman Brothers and AIG and the beginning of that episode. So I did that for 2-3 years, and then I was put in charge of the Bank of England and the UK foreign currency balance sheet. And to be honest, I thought that would be, to a bit of a rest after the global financial crisis. And then immediately the aftershock of the global financial crisis was then the sovereign debt crisis in the euro area. And so I was on the front line of that, both in the UK, managing the UK's reserves, which had a lot of euro area exposure in them, and as part of the international central bank coordination, putting in place swap lines, dollar funding outside of the US, or those sorts of kind of crisis management efforts. So sort of first-hand experience with those crises, and then I joined HSBC in 2015. And since then, I mean, it's yet a different perspective in the private sector, obviously. But because of my role, I'm still in the central bank world. I'm still in the sovereign wealth fund world, still in the sovereign pension world. A lot of the people I spend time with are the people I've known for 25 years, because there's a lot of overlap within those sectors. So I've sort of been associated with the institutions that have been managing, the Brexit crisis in the UK, and more recently, the COVID crisis. But, thankfully for me, I've not been involved in putting together a policy response to the most recent crises.
It's interesting, if you think back, all these crises we would have thought are 1 in 100 years events. And we've had 4 or 5 you just rattled off that have all happened in a very short amount of time. What have we actually learnt about the ability to maybe constrain some of the fallouts, the contagion that seems to always happen in these crises? Have we got better at dealing with these problems?
Yeah, I think we have, in the sense that we do a pretty good job of fixing the problem that caused the crisis we've just been in. And then something else happens. Look, after the Asian crisis, a lot of the lessons from that were around consistency of currency regime and monetary policy regimes. And you look at Asian balance sheets now, and they certainly learned the lesson from that crisis. Foreign exchange reserves are a lot higher. Economic governance generally is a lot stronger in Asia. So definitely, you would say Asia looks a lot stronger post the Asian crisis. The GFC was kind of a funny one in that, there's probably still an inquest going on now as to why didn't we see it coming. And the fact is, we kind of did see it coming. We knew that the trends in financial markets before the crisis were unsustainable. What none of us knew was that it was going to cause the entire banking system to come crashing down. So, we knew there was a search for yield. We knew that banks were on an unsustainable path. But I think, and I was responsible for a lot of the market outreach in the Bank of England. I think what we were thinking was, well, there could be a big hit to bank earnings. So banks could be kind of repriced. They'd have an earnings event over a year or a few quarters, but nobody could figure out the way everything was interconnected, and so the scale of the problem and the interconnections were what brought the system down. But were the lessons of that crisis learned? I would say they were. Banks have been massively re-regulated. So if the cause of the global financial crisis was an over-leveraged financial system, you've only got to listen to any bank CEO on an earnings call, and they're no longer, the masters of the universe shooting for 25% ROE targets, which they were in the 2000s. They're struggling to get into double-digit returns on capital now, and that's not an accident. That's partly by design. It was a very painful experience for central banks and finance ministries to go to prime ministers and presidents and electorates saying we need tens of billions of pounds or dollars or euros to bail out the banking system. And yes, they were given the money to bail out the banking system because, it was needed, but it came with clear kind of conditionality that this must not happen again. So there was a desire to re-regulate banks to make them a lot safer. And I think that has been learned. And the COVID crisis is different because that's like genuinely, it's what, we call an exogenous shock. It's like, it's something that has come from outside the system that's hit the system. It's not that the system has failed. It's like there's just been a public health emergency, and that's had economic and financial consequences. So, doubtless there will be some lessons to be learned by the financial system from COVID, but it's not like the GFC where you need to completely question the entire structure of the financial system.
Can I go back to one particular thing you mentioned, which was your role at the Bank of England, and you said that the role was market outreach. I think for a lot of people, when they hear that, they're not sure what that means, right? They understand that central banks are these omnipotent power that's out there that moves around. What specifically as part of that role were you involved in? Are you talking with other banks, getting an understanding of the liquidity that's moving through the system? Are you trying to find the pressure points? What does that mean?
It's something that I think at the Bank of England we pioneered that, and the Fed, the New York Fed especially, does a lot of that as well. But traditionally, central banks operate in money markets. They operate in foreign exchange markets. That's the kind of backyard for central banks. It's where they implement policy. So, when I first was in the markets area of the Bank of England, we were all over that. We had people whose job it was to do nothing other than talk to the FX market, talk to the money market. But then we realized, especially London, the major financial center of the world, it's not just those two core markets that you need to understand as a central bank. You need to understand that entire kind of ecosystem. And it started off kind of wanting to understand the financial markets and interlinkages so that we could better understand how, when the Bank of England changed interest rates, how did that feed through financial markets to the economy? And then it fairly quickly morphed into a kind of, central banks are responsible for the stability of the financial system. And they need to understand more about the structure of the financial system. Now, we've got far cleverer people than me that, with massive numbers of higher degrees who can sit in an ivory tower and build you a model of the financial system and do, both financial modeling, system modeling, look at balance sheets, et cetera, et cetera. But you kind of need to complement that with somebody who's out there talking to the market and just sort of getting the feel of it. So it's like, you come down from your ivory tower, you go out into the markets and bazaars and you talk to the great unwashed and you kind of, figure out what's going on, which then you can take back and the analytical people can analyze that. So I was asked to sort of lead that under a man called Paul Tucker, who was ultimately he was the deputy governor of the Bank of England, and Mervyn King, who was then the governor, asked us to build a network. So we had a network in London. We would travel to the US. We'd go around New York 2 or 3 times a year. I would go to Asia, so Singapore, Hong Kong, Shanghai. We'd go around the Euro area. So we built up a kind of global network of market contacts. And that was sort of how we figured out that, 2006, 2007, what was going on was probably, was unsustainable. There was going to be a correction. But as I said before, none of us knew that the scale of the correction was going to be a systemic crisis that brought down the whole system. But we were able to learn enough and ask enough questions and, elicit the feedback from the market players themselves. They were uncomfortable with what was going on, but they were kind of caught up in a dynamic that they couldn't break out of. And there's the famous Chuck Prince quote about the leveraged loan market, where someone said to Chuck Prince, who was CEO of Citibank, "This is unsustainable, isn't it?" And he said, "Well, maybe, but as long as the music's playing, I've got to keep dancing. And if I don't chase these return targets, I'll be fired and somebody else will." So that was the sort of dynamic at the time, and we sort of figured that out. But you can never predict 6 or 7 sigma event, I guess, but you can have a pretty good sense that something wasn't quite right.
It's interesting there, your quote about the music playing and you just got to keep going with it. I think about that in line with the too big to fail from the bank point of view. And if we think about it even more recently, when we think about some of the valuation, particularly in the US, of equity prices, it's almost that the valuation can never go down, right? That valuation stocks are too high, they're too big, they're too high to fail. And so there's this, I guess, this perception that the central banks are speaking to traders and trying to understand where the market structural problems are happening for that support to happen. And I think there's this link or this perception out there in the marketplace that the central banks are either directly or even indirectly, just through jawboning, inflating asset prices. I'm curious to get your thoughts on that as an idea.
Yeah, I think it. Look, I mean, it's not completely wrong, but I think it's a little. I think the kind of crude version of that is probably a bit unfair. So what, the way monetary policy works through a number of ways, but basically, if you're easing policy, one of the things you expect is you lower the risk-free rate. You'd expect that to pull down the discount curve, and that should mechanically feed through into asset prices, not just financial asset prices, but obviously real asset prices as well. And that's part of the transmission mechanism of policy. I think the dynamic now is, look, I mean, we've had a really slow recovery from the GFC for various reasons. There was, I think everyone expected there'd be a slow recovery because, we'd all read Rogoff and Reinhardt, and that you get a slow recovery from a balance sheet recession. So that was kind of priced in. But I think the sort of aftershock effect of the euro area crisis and the persistence of that was a drag on the recovery globally. And then even after that, it looked as if things were going to pick up, and it never really, the synchronized recovery never really got momentum. And so this perception that we're in more of a secular slowdown took hold. And there's not a lot monetary policy can do about a secular slowdown. But given central banks have got an inflation target and they're missing their inflation target on the downside, even if they think it's not a heck of a lot we can do about this, they've got to do something. It's just the way political pressure works, and we can talk about the policy mix later. But so they've got to stimulate. And if you look at the profile of the recovery we did have, it was extraordinarily reliant on personal consumption. And what was underpinning consumption growth everywhere was fairly strong growth in employment, but also the effect of rising asset prices improving people's balance sheets. So, rising equity prices, rising house prices did a lot to repair personal sector balance sheets, and that underpinned strengthening consumption, and strengthening consumption was what was driving the recovery. So it's all a very long way of saying if equity markets or financial markets fall a lot, there's a fairly good chance you're going to dip back into recession. So yes, part of the policy mix is we can't really afford asset prices to fall too far, otherwise the recession is kind of in peril. And that's as true of, like house prices is of equity prices, and probably actually house prices are more significant than equity prices for the mass of the population. But it is clearly a feature of the equity market, and that's what gets commented on a lot.
It sounds, or it feels more so like a cold confidence game. I remember in the previous run-up in 2007-8 in the US with house prices, there was very much the link between house prices. If your house price was going up, you're wealthy, you're a little more likely to spend. It seems that the whole narrative around the media has changed to being the stock market. And maybe that's also because in the US, the president's pushing higher stock prices that then leads to hopefully this confidence game that people feel that the economy is actually doing well because the markets are reflecting good times, and thus, you can then continue to spend. How much do you feel that this idea around equity prices stimulating the real economy is driven by this confidence game that not just central banks but even politicians are trying to push in terms of keeping people confident about the economy, confident about jobs, so that they do continue to spend, given the role of consumption in GDP?
Yeah, I think it's part of it, and I would say as a sort of central bank technician, which is what I spent most of my life being, pre GFC, we would laugh when people were reporting consumer confidence. We were saying, well, what's consumer confidence telling us? Consumer confidence is is an output, not an input, right? So consumer confidence is a function of level of employment, pace of real pay rises, et cetera, et cetera, et cetera. It's not independently telling you anything at all. And I think we're probably wrong about that in retrospect. I think confidence is consumer confidence and business confidence. Yeah, you can sort of certainly say, well, it's caused by the following factors, and you could probably model it. But it's also telling you something about, it's just like canes and animal spirits, right? It's you get out of bed in the morning, and it's the frame of mind you're in. Are you in a mood to go and buy a piece of capital equipment and shoot for higher returns in your business, or are you in a mood to kind of hunker down and protect the balance sheet? So I think in that sense, confidence does matter as much in a business investment context as in a consumer confidence spending context. And I think again, this is a topic that'll take hours and we don't have time to do it, but one of the puzzles in the policy world was, you kind of holding rates down, and part of what you're trying to do is keep the cost of capital for business down. And the thought process there was, well, if you keep the cost of capital down, you keep confidence high, business will invest, and that will reinforce the recovery. And the great puzzle was that didn't happen. So yes, you've got rising equity prices and low borrowing rates, and frankly, there's quite a lot of financial balance sheet engineering going on of buying back equity, leveraging up with cheap debt, but there's not a lot of seeing easy financial conditions translate into much stronger business investment, or at least not in a kind of the widespread way that people were hoping for. So I think confidence is kind of part of it on the investment side and the consumer spending side.
It's interesting you raised there about companies being sort of unwilling to spend and sort of moving towards financial re-engineering to utilize their capital more effectively. What does that say about the potential recovery out of COVID? And even prior to COVID, we were seeing a slowdown. COVID has now accelerated a number of themes around technical change, technology change, automation, and so forth. How do you think about the shape of the recovery since the drawdown, obviously we saw in March from an equity point of view, and then the play out of a number of industries going through a whole washout due to COVID? How do you think about that more broadly?
Yeah, I'm one of the joys of my job is that I'm a kind of top-down macro guy, and that's what I've always been. So I'm a kind of rates and currency guy. That's my background and macro. And since I've joined, the private sector, I'm learning a lot about the equity market. Now, as a policymaker, we just used to look at the equity market. Okay, what's the level of the equity market? Different countries. If we might, you'd look at small caps against large caps. You'd look at the international exposed sector against the domestic sector. But that was about as far as you got in looking at the equity market. And I'm learning now to, as you get into, different sectors, trends within sectors, equity factors, all of this sort of stuff, which in my day, and I think still probably central banks aren't, they're not all over that. And that is telling you something, I'm sure. So in terms of shape of the recovery, I mean, it's, people have got, is it a U shape? Is it a V shape? Is it a K shape? What shape is it? I mean, from a top down perspective, it's clearly a kind of it's in the shape of, the Nike swoosh, I guess. There's a big leg down. There's an immediate bounce back. And then the profile of the recovery slows as, economies gradually open up again. So you get a big bounce back in the production sector and in manufacturing. And then where the social distancing is really causing problems in large parts of the service sector, that recovers more slowly. So you get this kind of Nike swoosh shaped recovery as your best guess, I suppose. So the issue now is, are we on the, is the kind of recovery curve flattening out as we expected, or is it flattening out maybe going to dip down again. I don't have any special insight on that, but that's kind of big picture. I think that's what the state of the recovery is, and then within that recovery, you've got different profiles as different sectors recover at different rates. And the obvious, look at the countries that have been hardest hit by COVID. It's no great surprise that it's the countries with the biggest service sector. So in the UK, we've been badly hit. In France and Spain, in Europe, big service sectors, big tourist sectors, a bit more hit than Germany, which is a big manufacturing sector, more hit than China, which is a big manufacturing sector. So that there's a kind of an obvious kind of service production sector kind of dichotomy. And then the interesting stuff, which I think is, what your question is implying is, well, even within sectors, what sort of stories can you tell and what can you look at? And then you're tapping then into a longer debate. I think it's not just the recovery COVID is shining a light on divergent trends between and within sectors, but it's kind of, I think it's maybe it's exaggerating trends that were already in place. So I look at, again, I'll switch back to top down mode. My good friend Andy Haldane, who's chief economist at the Bank of England, he's done a lot of work on why has productivity growth slowed down so dramatically in the UK in the last 10 years relative to the previous 50, 60, 100 years? Because that's been a real puzzle. Why has productivity growth been so weak since the global financial crisis? And it's true of other countries, not just the UK, but it's particularly marked in the UK. So Andy's looked into that, and what he discovers is there's a very small number of companies that are doing very well. And there's no obvious sectoral pattern in that. There's no obvious regional pattern in that. You can have two companies in the same sector that are 50 miles apart, and one will be going great guns and the other will be stagnating on any kind of metrics you look at it. And part of the answer seems to be they're just adopting new technology at different rates. So, we've got the so-called fourth industrial revolution. And oddly enough, two companies doing the same thing just down the road from each other can be adopting digital technology at radically different rates, and that seems to affect the outcome. There's a kind of lack of labor mobility, so there's not the sort of churn of ideas through labor market turnover. And that, it's really interesting. And as an aside, I used to wonder what's the private equity business model. Well, if there are two companies in the same sector doing the same things with much the same workforce, and one's doing a lot better than the other, and you can figure out why that is, then you can presumably you can change the management and the ownership, and you can adopt best practice. But so that's sort of part of this sort of sectoral puzzle as well. So yes, some sectors are clearly doing better than others, and you can point to secular trends and say, well, it's they're benefiting from digital, so the Zoom or the FANGs or whatever. Some are kind of national champions. Some of the big Japanese corporations, some of the big US corporations, and they're kind of benefiting from network effects and just scale and size. But there's a genuine puzzle as to why, say, new technology is not being adopted at the kind of rate you'd expect it across whole sectors. So there's multi-layered kind of puzzles.
Do you think that there's a place maybe for monopsony to help explain that story? You've got some very dominant large players that are the only suppliers in many towns and areas. Is that a potential cause of this?
Yeah, I'm not an expert on this, but prima facie, yes. I mean, there's enough people that are experts on that make that point that clearly some companies are benefiting from network scale effects, barriers to entry, I know it's a live debate in Europe with the US tech companies, obviously. So it must be part of the narrative, yes. But I think it's not the only thing that's going on. I mean, it is. I'm becoming a bit of a nerd on this, but this sort of pace of technology adoption thing is fascinating. You look at because if like for 750 years, living standards were stagnant between 1000 AD and 1750, and then you have the Industrial Revolution, which initially was steam engines, right? And it takes about 50 years for steam engines to become a universally adopted technology. 150 years later, you invent the internal combustion engine. That doesn't take 50 years to be adopted globally. It's more like 5 or 10. And so the pace of diffusion of new technology has been speeding up since the Industrial Revolution. And now with the sort of digital revolution, it seems that there are it's kind of slowing down, or it may be slowing down. So that's I find that fascinating, and I'm probably more fascinated by it than is justified by the facts. But it's once you start looking at what's driving corporate behavior, corporate performance, getting into the guts of the equity market, you kind of get sucked into some of these stories.
I'm curious around the links between the pace of change, the technological change that you describe, and the monopsony power as well, and what impact that has on potential inflation or deflationary potentially forces. How do you think about that trade-off? Because when I think about the technological change that you describe, to me that's very deflationary. The amount of lowering of interest rates is also quite deflationary, I would say, because it allows companies to produce now at cheaper rates, and it also allows companies to be losing money for 5, 10, in some cases like Amazon, for almost 20 years, where they make nothing, no profits. And ultimately that allows them to build their business, and that's deflationary. How do you think about the current maybe macro environment in terms of low rates, and then this corporate environment with so much technological change? How does that play out on the inflation deflation debate?
Look, I mean, what you've just said, it's both fascinating, and I think it's one of the big debates certainly in the official world at the moment. Exactly to your point around is kind of low rates, negative rates, is that in some sense deflationary rather than stimulatory, is one strand, and there's a lot of disagreement, I think, in the central banking world about that. And then the other strand of it is, to what extent is disinflation caused by technological progress or supply side reform? And it's, I can remember, the Japanese have been trying to raise inflation for 25, 30 years, and they're really smart people and they work hard. And they've tried a lot of things and they thought hard about it, and they haven't managed to generate inflation anywhere near where they want it. So one of the explanations they talk about is, well, a lot of supply side reform causes disinflation in the short term because relative prices move. So you deregulate a market, producers have got less power, you introduce more competition in the market, and the level of prices of output falls. Probably better than I do, Moore's law and computer technology, et cetera, et cetera. So the price of a lot of consumer goods that are based on electronics have been falling in nominal terms, and that's due to technical progress. Now you can try and sort of hedonically adjust your price levels, your price measures, but even so, there's what the Japanese call good deflation, I suppose, which is due to positive supply side performance. Is clearly part of the story, and then there's this debate within central banking as to, particularly about negative rates, as to whether that is in the long run going to be a stimulatory thing or whether it's not. And the people currently doing the jobs, I think, in the central banks would give the orthodox response, which is that if you cut real rates, that should be stimulatory. interestingly, if you talk to the generation above this generation, so I was at a conference recently with Jacques de la Rosière, who was governor of the Banque de France in the early 1990s, head of the IMF in the late 1980s, and he's sort of 95 and amazingly still thinking and active, and he would argue that negative rates or very low rates are ultimately deflationary. So largely for the reasons you give, it doesn't give businesses the incentive to innovate. It means that if consumers, well, people, that's not call them consumers, let's call them people. If people are saving for retirement, then clearly if rates are low, expected returns on asset classes are low, you've got to save more in the short term to hit your savings target. And that is, that sort of substitution effect is deflationary rather than inflationary. So that debate it sort of rages within the ivory tower, I guess. It doesn't sort of permeate so much beyond, but it's part of the picture as well.
I guess the other challenge that comes up, and why central banks are pushing for so much inflation, or at least getting above 2% even inflation, is the debt load is so large. And I think they're worried about how to manage that debt load. And we hear a lot of talk about this modern monetary theory coming through, and whether that can help. We seem to be seeing even just the remnants of it already, that it's out there. I guess the question is whether that will be effective. And then the other piece, I think that a lot of, institutional investors are worried about is if they start, which is if they being the central bank start giving digital dollars to actually people, would that be the kicker to start driving inflation? So I wanted to get your thoughts on that, particularly around the worry for inflation with such low interest rates. The convexity or the change there that we see can be so significant to institutional investors that have very long duration assets. So if you could talk to the MMT and maybe the digital dollar piece and whether that could drive inflation, and then we'll go back to the piece around long duration assets.
Yeah, that once you start talking about that, it's sort of, you can have a theological debate about whether you're talking about monetary policy or fiscal policy at that point. And remember that there was a few years ago, people were saying central banks are the only game in town, right? And I think Mohammed, not the prophet, Mohammed El-Erian actually wrote a book with that as the title, Are Central Banks the Only Game in Town? And that was, in the sort of central bank circles I was in, that we'd been talking about that for a while. And I think that, the bigger insight is not, are they the only game in town? It's that they're the fastest gun in town. So when the trouble starts and something needs to be doing, the central bank is going to do it a lot quicker than governments are, either through fiscal policy or structural policy, because central banks have got a balance sheet. They're in the markets every day. They've got a transparent inflation target, and they've got a whole bunch of tools they can use to stimulate the economy. So they're the fastest gun in town. And they become the only gun in town because politically it's very difficult for politicians to make the changes that arguably they should be making. And famously in Europe, Jean-Claude Juncker, who was most recently president of the European Commission, but when he was prime minister and finance minister of Luxembourg, he came out of a Eurogroup meeting and the journalist said to him, the ECB has done this, this and this. Why is all the pressure on the ECB? Why aren't you guys doing anything? Don't you know what to do? And the answer, and I'm paraphrasing a bit, what he said was, well, yeah, of course we know what to do. What we don't know is how to get ourselves re-elected after we've done it. So there is this dynamic that it just puts the central bank, fastest gun in the town, or it makes them the only game in town because the politics of fiscal policy are harder. So I'm not trying to avoid the question. So then you talk to the fiscal policy makers, and of course they know that monetary policy is largely played out, and the onus is on them come up with a fiscal response in a lot of ways, and to introduce kind of structural measures that might get us out of the slump. But it is politically very hard to do, and as everybody knows, and it's obvious, electorates everywhere are kind of angrier and angrier, and that just makes politically difficult things harder to do. The interesting thing about COVID, and I kind of mentioned this earlier, is because it's a shock that's come out of almost clear blue sky, or it's a shock that's come from outside the system, it sort of makes it easier to do things that previously were politically just almost impossible. So like the European Recovery Fund, we've now got a proposal for fiscal transfers within the euro area, and the size of that is something like 5% of euro area GDP, which you'd think is, in terms of the scale of what might be needed, doesn't sound like a lot, but in terms of the scale of what might have been possible 2 years ago, it's an enormous amount. So this is all a long way of saying that, before you get to MMT or really quite off the wall solutions, there's an awful lot of conventional things that can be done, but the politics needs to shift before those things can be done. So I think you'll get, you're clearly going to get more conventional fiscal policy before we get unconventional fiscal policy. And I would classify, helicopter money as, whatever we want to talk about as unconventional policy. That sort of unconventional fiscal monetary policy mix. People, they'll want to exhaust the conventional options before anything unconventional is tried.
So specifically to the question about for asset owners, institutional investors, when they think about their allocations, being a long-term investor, they're typically got long duration assets. Should they be worried about the inflation piece of the puzzle starting to pick up in the next, I guess, medium term, or do you feel that things are still going to take quite a while to play out given the current COVID situation?
Yeah, look, I mean, I would have said before COVID, I was saying the same thing, and I still say the same thing now. It is hard. I mean, people worry about inflation. They worry that inflation risk is underpriced, and actually, deflation risk and inflation risk both look underpriced, and I kind of get that. But if you say, what do you expect over the next 5 years? I wouldn't expect inflation in developed economies. Now, we have to be kind of quite precise about what do we mean by inflation. By inflation, I think we mean kind of a persistent rise in prices, usually typically, well, almost always caused by pressure of excess demand on supply. So you can get what people call inflation as a result of a currency depreciation. But that really, yes, I mean, mechanically prices rise because the relative price of internal and external prices change, but it doesn't necessarily cause persistent inflation. Are we going to get inflation caused by excess demand weighing on the supply side? I honestly don't think we are. I find it hard to see the conditions for that over 3 to 5 years, and beyond that, who knows? But it did. So I think yes, investors, including investors in Australia. I've been talking with Australian asset owners recently, and they're worried about inflation as not quite a tail risk. It's not part of the central case, but it's not quite just a tail risk either. It's somewhere in the kind of how do we plan for this, and it usually goes with, I think, the point you've made, which is how do we look at the construction of the portfolio. Government bonds are the kind of the risk-free asset. How comfortable are we with our government bond allocation given real yields? How much more scope is there for prices to rise, yields to decline? So that's sort of on their minds. It wouldn't be part of the sort of central case. I don't think. I think we're into kind of risk planning, and there, it's always the case that people have got different views on the risk. So I pick up different strands from different investors in different parts of the world.
So final question, and it comes back to risk planning, and that is, investors can be often blindsided by a lot of things. Given the amount of people you've spoken to over the last 25 years and more recently, what are maybe some of the blind spots that investors have missed, or that need to be at least paying attention to, in the next 3 to 5 years? I know we've got a US election coming up, but beyond that, what are some of the areas maybe for them to watch?
I think it's, obviously political risk, geopolitical risk. One of the things you find as you get older is that people say, there's a lot of geopolitical risk. And, well, do you know what? There always is. There's always geopolitical risk. There's always political risk. And it's just something, you just have to live with. So that's always there. And you can't really, honestly, it's not risk, it's uncertainty, and it's very hard to model uncertainty. So in terms of, I would kind of characterize it as there is almost a nailed-on consensus as to what is the central outlook for the next 3 to 5 years, and the interesting discussions are around what are the risks. And so I wouldn't say that it's obvious. I'd be as blind as anyone, but is there an obvious blind spot? Not really. I think we're all thinking about the right things, but it's you can never kind of get the exact scenario right for when the risk hits, and it's the kind of the interlinkages between things. So, as I said, I think everyone was surprised by the extent of the euro area sovereign crisis after the GFC, and in retrospect, you can make sense of it. Everyone was surprised. Who would have thought in 2006 that Royal Bank of Scotland, Citibank would effectively fail? So it's those things that kind of combine that trip you up, whether as investors or running a bank. But we're not blind to any of the individual risks. I don't think it's just how will the risks play out and how might they combine is the difficult thing. So not a satisfactory answer, I'm afraid. But in terms of how are we running our business, we're kind of running our business in the way that is in line with the consensus everybody else has got, which is expecting slow growth in developed economies, expecting investors to access developed economies through kind of, passive type beta capturing kind of vehicles, expecting Asia particularly to grow stronger, expecting investors to be prepared to pay for managers who can find excess returns in Asian and emerging markets, expecting the kind of move into alternatives to continue, because there's liquidity premia, complexity premia that are still there to be had. Now, all of that implies we're in this kind of coupon clipping environment where there's very little market volatility, very little macro volatility going forward, and everyone is in a coupon clipping, premium harvesting kind of a mode. And I think, we're running our business on the expectation that that's what's going to happen. And I think that's the central case for most of the investors we talk to.
I have two particular pieces of risk that I look to. One being the swap lines, the US dollar swap lines, and what's happening there is of interest. And the second one being foreign exchange, the quite large movements we've seen of late in US to euro translation, US to Australian dollar. There are just two ones that I look at. And given the amount of central bank influence on markets and the amount of fiscal policy and the managed economies that we're seeing, it seems as though the FX is the blow-off valve for these pieces. So they're the two areas that I always keep an eye on and see the volatility. Just wanted to get your final thoughts on those two.
No, the FX. The FX swap was that was my canary in the coal mine when I was in the central bank. And when that started to move, you knew that risk appetite was changing. So absolutely, yeah, that is the canary in the coal mine are those FX swap rates. And just as an aside, I mean, we ran. I was chairing a load of client panels that we did in sort of June, July, talking about how investors managed through the crisis. And we had a man called Simon Potter, who's a good friend of mine, who was head of markets at the Federal Reserve until very recently, on the panel. And we were kind of, a lot of the investors were making the point that, they were really fazed by how liquidity dried up in March in dollar markets, especially onshore and offshore, so through the swap markets. And, kind of given all the rhetoric coming out of the US, the Dodd-Frank Act, how was it going to be, what were the US authorities going to do? And everybody was really kind of pleasantly, I would say in many cases, surprised that the Fed and the Treasury acted as quickly as they did to, resurrect all the crisis era facilities domestically, reinstate the swap lines, extend the swap lines. So absolutely, that's kind of that's the key vulnerability in the system. And, it's just enormously kind of encouraging that despite everything coming out of the US over the last decade, they run the global reserve currency. They're kind of aware of the responsibility they've got, and they're on the case. And so, yeah, big vulnerabilities there. But I think the Fed has got their arms around it.
Mm-hmm. All right. That's been a fantastic conversation. Thank you very much for your time today, Michael.
Okay, Alex, it's been a pleasure. Thank you.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.